Good morning, our dear customers. Once again, thank you so much for logging in this morning. We really appreciate your time this morning. And it's to our prayer that each one of you is in good health and keeping safe as well. Our customers and our dear esteemed customers this morning, we'll have our webinar session for KCB Capital. And as you may all be aware, our session for this morning is investment solutions for long-term financial stability. Allow me to introduce to you the panel that you have this morning as I take you through, minimum housekeeping for this morning. So on the call, we have Catherine Tipapa, the head of Advantage Banking. We have Leah Okulo, Managing Director, KCB Capital. Timothy Masharia, Equity Dealers. Linus Kangara, the head of Brokerage. And my name is Anne Madenge, who will be moderating your session for this morning. To my dear customers, remember on whichever gadget you're using this morning, there's an icon for Q&A. So feel free to engage our panel that I've just mentioned this morning to ask for any clarification, for any feedback, and for any compliments that you may have on our topic of discussion. Once again, our topic of discussion is investment solutions for long-term financial stability. Allow me now to invite Catherine Tipapa to open the session with opening remarks. Catherine, over to you.
Thank you, Anne. Good morning, everybody. And thank you for logging in this morning. This morning, we are going to have a session with KCB Capital. As Anne has said, my name is Catherine Tipapa, and I'm the head of Premium Banking, which is all of you who are logged in to this call today. Now, the bank has embarked on a journey of diversifying your investment solutions and adding value to yourselves for the long term. So this is what we are going to be discussing this morning. And I'm going to introduce Leah Okulo, who is the Managing Director of KCB Capital. KCB Capital is part of KCB Bank Group and focuses on all these bespoke solutions that will increase your wealth, either as an individual or as a business. Leah, karibu sana, please talk to the customers and tell them how they will maximize their returns and minimize their risks. Karibu, Leah.
Thank you so much, Catherine, and good morning, everyone. Very happy to be part of this engagement session this morning. As Catherine mentioned, we as a KCB group in entirety are continuously looking at how to meet your needs as our customers in an environment that's rapidly evolving, and your needs are also becoming more sophisticated as the market becomes dynamic. So for me this morning, I'll give just a brief introduction of who KCB Capital is. Some of you might not have engaged with us in the past. So KCB Capital is the investment banking of KCB Group. We are fully owned by KCB Group. We are also fully licensed by the Capital Markets Authority and also regulated by the Capital Markets Authority. So with that in mind, we have two key areas of focus as a business at KCB Capital. One is the advisory side of the business, which is really corporate finance type advice, where we are looking to advise clients who are looking at long-term strategic needs of their business. Be it we have clients who might want to go to other markets by way of mergers and acquisitions, looking to have an additional business line within your business. Some clients are looking at ways of getting into the capital markets. You might be looking at things like listing, going IPO, mergers and acquisitions. So we are able to come in and advise you. And over and above the products that the bank is able to offer, and this is both KCB Bank and NBK, which is currently part of the KCB Group, we're able to offer additional financing, be it equity, mezzanine finance, engagements with strategic investors, institutional investors who might be a good fit for your business. So we're able to make these linkages and advise as well as complete on the capital raising. The other side of the business is the brokerage business. And this is where we offer investment advice to our clients like you who are looking to make investments in the capital markets, be it in equities or shares within the Nairobi Securities Exchange, or clients who are looking to make investments in government paper, be it bonds or treasury bills. And we are continuously looking at how else can we meet our clients' needs by additionally providing more product, working very closely with the retail team who holds dear relationships with you as our clients. How do we meet your needs in an ever dynamic environment? On the advisory side, we also work very closely with the corporate team. For those of you who may be our corporate clients, we continue to maintain that relationship through the relationship managers that you have worked with over the years, but see what else can we bring to the table to ensure that we are continuously being innovative and meeting your needs in an ever dynamic environment. So with that in mind, I'll just stop there. I look forward to engaging further with you over the next coming months to see how we can help you meet your needs. So with that, I'll just hand back over to Anne to continue the rest of the session.
Thank you. Thank you so much, Leah, for that introduction. Our dear customers, on the program now, we have Timothy Masharia, and Timothy Masharia is going to be taking us through personal wealth, that is growth versus savings. How do you select a suitable investment? What are the various asset classes that we have? And investment in shares, you might be wondering, should I invest in shares or REITs or gold ETF? And probably someone is asking, what is ETF? Kindly stay tuned, and Masharia is going to take you through that. Allow me now to introduce to you who Masharia is. Timothy Masharia is an equities trader at KCB Capital and has over 6 years experience in the capital markets, equities, and fixed income trading. He has previously worked as a senior equities trader at Genghis Capital, as an equity trader at NCBA Investment Bank, previously known as NIC Capital, and Dare & Blair Investment Bank. He holds a Bachelor of Commerce Accounting from Kenyatta University and is a certified public accountant and is currently pursuing CFA Level 2. Remember what Timothy is going to take us through. Please feel free to ask any questions. I'll give you an opportunity to answer 3 before I invite my next panelist. Over to you, Timothy. Asante.
Thank you so much, Anne, and Leah and Catherine for that insightful presentation and introduction. As you've heard, my name is Timothy Masharia. I work for KCB Capital as an equities trader. I also do fixed income trading. So, and to start us off as the foundation to the rest of the presentation, I'll be presenting a topic on personal wealth, specifically on financial stability. And I want us to focus on financial stability because I feel it's a topic that will lay a good foundation to whatever we are going to present in terms of solutions that we will be presenting today. So what is financial stability? Financial stability is the ability to hold amidst variations in circumstances. And the reason we have these variations is because life is random. And life is random and is very uncertain. In other words, it is very unpredictable, or it's very difficult to predict. Randomness brings surprises, and these surprises, we call them in financial terms risks. Surprises brings shock and stress. Anywhere we don't expect something, you expect that if the risk materialize, there'll be stress, there'll be shock, there'll be a crisis, because we never prepare for them. And these shocks can usually happen in any element of our life. Can be social, a divorce in a family, can be economic, where sources of our income have been affected, can be political. This one is very close to us, especially in our country, can be health, an example of maybe a sickness or an accident. And when these shocks happen, there are only 2 outcomes. So we either survive or we break. But why do we break and survive? It's because we are either fragile or we are robust. And that is very important for us to think when you are thinking about stability, fragility and robustness. So let us start with the fragility, because I think is a good point to lay a ground. So what causes fragility and what is fragility? Fragility is susceptibility or vulnerability. So what causes fragility? especially on our personal or as a person or even in our businesses. Number one is over leverage, or what we call indebtedness. So this one is number one cause of all financial meltdowns in the world, on a personal level, on a company level, or even on a country. Indebtedness. Even right now we have a discussion whether our debt as a country is sustainable. So that is number one cause of fragility. Number two is something called FOMO syndrome. This is the fear of missing out. And here social comparison is the issue. Why social comparisons? We are envious beings. And you always tend to feel like you're missing out if you're not doing something that your friends or your colleagues are doing out. So you end up doing something or making a decision based that you don't want to fear. Number three is wealth signals. This is where you do something to portray like you're rich. You buy something to signal that you're rich. In French, we call it kama umeomoka. So, but this is what you forget, that if you spend money on things, you end up with things, not money. Wealth, in fact, is what you don't see. So number four, cause of fragility is dead capital. Dead capital is having assets that are not returning or are not growing. And there's a pretty example of this one. Maybe you have two homes, one you don't lend, it just sits there, it doesn't increase in value, or even if it has any growth, it's very minimal. In fact, any asset should return minimally equal to a bank deposit or a treasury bill, because those are the safest assets. So if an asset is returning less than that, then that one we can call it dead capital. Number four is what we call human biases. And these human biases are various. Like I'll touch a few of them, but I hope it's the others. But just to get an idea of what I'm talking about, there's overconfidence. This one leads to underestimation of risk and overestimation of returns. Then there's survivorship bias, where in your decision making you just consider outcomes that have survived, and so you end up having skewed results, which you are basing your investment advice. Then there is what we call sunk cost bias, and this one we are very prone to. This is putting good money into bad money, simply because you cannot let it go. If you have an investment, it's not working, you continue pumping money even if you realize that this investment is not working. And then lastly is confirmation bias. This one is selecting investment that support your belief, cherry picking evidence. So if you have an idea that a certain investment is okay, or you believe is good, even if there is this confirming evidence that investment might not be as good, but you cherry pick evidence and you just comfort yourself that whatever you're doing is okay. So that is it for financial fragility, and those are some of the things that can cause you to be fragile. So let us go to robustness, which is very important. And what does robustness offer to you? Robustness offers capacity. Capacity is the ability to absorb shock. And I'll give a very good analogy here. Our bodies, or as a human being, or even other creatures that are in the universe, have survived by the fact that they have learned the ability to have extra capacity. Our bodies have learned that. And our bodies always have that extra capacity. If you look at your body, you have two kidneys. And even when you can survive with one, your body has two. Your immune system has or your maybe even lung capacity. You don't operate at optimum. You always have extra capacity. In a branch of medicine called toxicology, I hope we have doctors listening to us, there's a concept called homeostasis. Homeostasis is a concept where you introduce a small poison in your body so that, and this is a concept of even immunization. You introduce a small poison in your body so that you make your body to overreact and create a buffer, because your body will not just fight that small poison, it will create more poison for unexpected huge amount of poison that it might occur. So that is called homeostasis, and this has been the background or backdrop of evolution. That is how we have survived when even other species, died long time ago. So that is a concept called homeostasis. But why am I insisting on capacity? Because capacity or what we call shock absorbers is one element that has caused us to survive this long. So number two that robustness offers is downside protection, that your lifestyle might not, be very fragile, or it might not shrink. And finally, freedom, optionality, the ability to do what you want, with who you want, where you want. So what causes this robustness, and how do we create robustness now that we have an idea of what it does to us? Robustness is a good thing. It's very important in our financial life. How do we create robustness in our financial being? Number one, and the very basic, is savings. Savings creates a cushion or extra capacity that can absorb such a huge amount of shock and stress in our lives. And as you said, we'll always encounter uncertainties and risks. So we need to create a layer of cushion that can ensure that we survive those uncertainties and those crises and those shocks and stresses. Life is about growth, and financial growth is also a very important factor. And financial growth is a factor of savings and return on the savings that you've return on you get from investing those savings. And how do you save? I understand there are a lot of theories that have been, taught to us about how we can save, budgeting, studying orders. But sometimes we've been frustrated because they seem not to work. Why? Because at the point of your expenditure, you hardly remember your budget, or you'd always find a way to cheat your self-installed system. Yeah? You know it better. This is a way to save, and I'll give it in one jab with 100% efficacy. Better than the COVID vaccine. I understand COVID vaccine, you have to get 2 jabs. This one I'll give it in 1 jab, a practical way to ensure a saving culture. Reducing your ego. Ego is the enemy. And I repeat there, reducing your ego. And what is ego? Ego are those voices in your mind that tells you you can't do certain things. You can't live in a certain estate. You cannot wear a certain brand of clothes. You can't drive a certain car. But this is the thing. Our ability to deal with scarcity is so huge and very natural. We are born with it. It's inherent. As a matter of fact, you are born with nothing, not even your clothes, leave alone the designer ones. It's inherent. So lifestyle is something that we learn, and we can unlearn as fast. So we need to adjust our ego. You need to be humble, to be a little bit frugal. And I'm not saying that you starve yourself of good things, but before you indulge yourself in luxuries and good life, ask yourself whether you are fragile or robust. If you're robust, then indulge yourself. You have all the light, and that is why you need to be robust. But if you're fragile, first things first, work on your robustness. Work to reduce your fragility. As a matter of fact, something that has been tested is that the more rich we are, or the more abundance comes to us, the more we become fragile. In fact, we don't know how to deal with we have never learned how to deal with abundance, whether of wealth, of power. You've heard some people say that when some people get to power, they change. They don't change, is that they don't know how to deal with abundance of power. When people get rich, they change. They don't change. They don't know how to deal with a lot of money. So you need to learn how to deal with it. Number 2 item on robustness is investing. Once you have savings, you need to invest, and quality investment through research and due diligence. You need to commit time to invest. And investment is not something that is very easy. You need to commit. It's not a respite for hard work. You need to work more to save, to ensure that your savings yield and give you a good return. Number 3 is consistency. Here you get what you call power of compounding. Just remaining on course, not forgetting what you're after. You want to be robust. You want to be unbreakable. And that is why you need to set the eye on the goal. And then finally, diversification. And here I want to quote a great investor, Howard Marks. And this is what he said concerning diversification, that here is a part of trade-off with diversification. You must be diversified enough to survive bad times or bad lucks, what we are calling those risks and crises, so that skills and good process can have the chance to pay off over the long term. So that is very important. You must be diversified so that it ensures that you survive, so you don't get ruined. So I hope that that foundation, presentation on financial stability lays a good foundation on the rest of the presentation that you're going to have. And I want to jump next to, then once we have saved, then how do we select good investment? So selecting a good investment, what are the factors that you consider in selecting this good investment? And number one, I want to start with risk and return. The whole point of managing risk and return is minimizing regrets and maximizing return, so as to build a portfolio that will just do fine in a wide variety of scenarios. And these scenarios, we've said we can't predict them. So they are unknown scenarios. So we are trying to build a portfolio that can do just fine in these unknown scenarios. The best we can do is to find out which risks are necessary, which ones we must avoid, and which ones will minimize our long-term regret. And this is a very personal undertaking. Minimizing regret is very personal, because sometimes some of us or some investors have capacity for risk, others don't. So you need to really understand. And these are decisions you make at your dinner table. You want to look at your wife or your kids and know that whatever decision you make will not affect them negatively. Number two aspect that you need to consider in selecting a suitable investment, number one, we said, is risk and return. And just ensuring that we minimize regrets and maximize returns. Number two is liquidity. You want a portfolio, you want to balance your portfolio such that you meet your obligations timely, but also your portfolio is also generating returns. That is kind of a balance, because a combination of maybe some liquid and illiquid assets will generate you returns, but also make sure that you're meeting obligations when they fall due. Number three is income. Selecting investments that you can afford. Not all investment you can afford. So it's very, very good to match your income or your savings with the investment option that you can afford. Number four is investment horizon. So you need to ask yourself, this investment, when do I need it? Is more tied even to liquidity. When do I need it, and when I need it, will it be available? And lastly is unique preferences. Some investments have or some people have preferences for some things, but I'll give you an example. If you're a Muslim, you want a Sharia compliant product. That is a unique preference, because others might be looking on other kind of investment. So that is it for selecting a suitable investment. Those are the things that you should check. Number one, risk and return. Number two, liquidity, income level, investment horizon, unique preferences. So let us go to then what are we selecting from? We are talking about selecting investments. So where do we select from? And I want to touch a topic on asset classes. Asset classes, these are the options available for investments. And all investments fall within these categories. Number one, we have cash or near cash items. These are, you can hold cash in any form, your M-Pesa wallet, your account, even hard cash that you can hold. So that is a category of asset class called cash. Number two is equities. Equities is ownership in a company, can be in form of stocks, can be in form of a private ownership. You hold a shareholding in a company, can be in form of equity funds and so on. Then you have fixed income. These are debt instruments that you can invest in. This is basically lending. So you lend your money. You can be to maybe to the government or even to companies. That is in category called fixed income. Then there are commodities. This one maybe we are more familiar maybe with things like coffee, things like tea. There are gold, copper, beef, corn, and all those commodities. These are ownership in real goods, things, goods that have usability. And then we have finally real estate. Real estate, maybe these ones we are familiar with the common one around here, the direct investment where maybe you have land or you buy a plot and build. But also we have other forms of investments where you have rates, we have commercial, we have mixed use, we have others called LOICs, and I think all this investment, and that is where maybe I want to touch is that all these investments are available in our capital market and can be invested, but maybe not in the typical way, even real estate. And that is when I want to maybe go to the next slide on specific areas of shares, rates, and gold ETF. Maybe we are not very familiar with maybe the last two, but this category of investments are available in Nairobi Stock Exchange, and as KCB Capital will help you invest in them. And we'll also advise you so that we make sure that you get the best out of it. Number one, let's start with shares. Shares, this maybe we are familiar with it. For example, we have Safaricom shares, we have KCB shares. This is your ownership, but you buy them through Nairobi Stock Exchange. And shares you earn in two ways. It's something called capital gains. Once you invest in shares, you can earn through capital gains, where the share price appreciates, especially when you select good companies that will always be in demand. So with time, as companies performs well, people will demand that share, and the price will appreciate. Now you get gains through something called capital gains, the appreciation of the share price. And number two, you get earnings. This is the distribution of the company earnings to shareholders. And most of the companies distribute these shares. On our slide, you can see that we have a sample dividend payout that we've compiled. These are just a lot of companies give dividend, but these are just select few examples. We have BET with a yield of 9.5%, Coop with a yield of 8.4%, Stanchart and Safaricom. These are yields, and just this is one side of the return. You can earn dividend and still get capital gains. So you can imagine combined return will be high. So it's a very good type of investment, especially when you select good companies. And that is why we are, as KCB Capital, will help you select good companies that will give you this dividend return, but also give you capital gains. So collective, your return will be good and competitive. Then number two, we have something called REIT. And REIT stands for Real Estate Investment Trust. And this one, a company called REIT is formed and invests in property. Maybe with our incomes, we may not afford to invest in properties, and especially prime ones, because they are very expensive and way out of our reach. But then we can get a unit of exposure. So this company goes and invests in these properties, and these properties are high yielding in terms of rent. And then it distributes the rents to us. And most of the times, they have a cap of about, they already distribute about 75% of their correctings. And this cash distribution will come to us. And also, you also have an exposure to capital gains, that these rates, since they are listed and they are priced, they'll always appreciate in price. If the rate and the property invested in perform well, and the rent maybe goes up, or it's have good performance, they'll always distribute cash distribution to unit holders. It's kind of form of dividend, and then the share price or the unit price of these rates will appreciate. So you get also a double-fold return. Number three is something we call ETF. ETF stands for electronic, ETF stands for New Gold ETF in our market here. And New Gold ETF is a form of ETF where they have actual gold, but since they cannot sell to you the gold, they buy the gold, but then you buy into that unit. So in other words, you have exposure to gold. And that is the first one that has been listed. I hope the other coming. So if you want exposure to gold, and gold is a very good hedge against volatilities, economic volatility. If you want exposure to gold, I understand maybe you don't know where to buy gold. If you want to exposure to gold and the performance of the gold anywhere in the world, this is the instrument to buy. The thing with ETF, gold ETF, it doesn't distribute dividends, but then you stand to gain in terms of capital gains, because the price of the ETF will always appreciate. So it's a very good exposure to balance your portfolio. We talked about diversification. You want to diversify in different asset classes. So why should we invest in shares, rates, and ETFs? Because these are items that are listed on exchange, they are accessible. So what are the benefits, apart from maybe dividends and the cash distribution we talked about. Number one, as I had said, is diversification. You want to diversify your portfolio. Number two is potential high returns. And I've said that things like rates and common shares, they are twofold return. One, capital gains, and two, dividends. Number three is liquidity. It provides you an opportunity to exit anytime that the investors want ready cash. Because and exiting, especially in our market on all those, settlement is transaction day plus 3. So within 4 days after you sell and the liquidity is there, they're already buyers, you'll get your money. Then number 4, and the most important, is that these ones are regulated. They are regulated, and regulation gives them a buffer in terms of risks. So you are sure that there's someone else there beside yourself who has done due diligence on these companies and is seeing they are solid, and that is the regulator. They are called the Capital Markets Authority. They are the one charged with regulating all these products. They ensure they are healthy. They can be distributed to shareholders. They have good corporate governance. They are not flawed and such. So it adds a bit of confidence in your investments and make sure that your investment is solid and will not just evaporate. And then finally, is that all these investments, they fall in a category called medium risk, so that they are not risky investments. Si patapotea, you may not stand to lose all of your investments. The shares might fluctuate in price, yes, but they always fluctuate in a slow way. You know, just wake up tomorrow and here a KCB share is at 0 from maybe a price of 50. No, they have controls that have been put in place to ensure that you as an investor, you are safeguarded. So our dear investors, I would like to thank you so much and really invite you to these investment products. They are very good. Diversify. I know maybe you are so invested in our businesses or even land and buildings, but this one is also a good class of investment that you can invest and diversify, and also gives you all these benefits that I have highlighted. And I hope that this presentation have been of benefit to you. And as you make your decisions, you can always consult us and we'll guide you on how to go about it. So that is it from myself. Back to you, Anne.
Thank you so much, Timothy. I have a couple of questions for you, but what I will do for our dear investors who have just joined us, were not with us probably when you kicked off the session in the morning, is that we'll have another panelist on with us this morning, and that is Linus Kangara. And Linus will be able to take us an in-depth conversation about how he will take us through bonds, why you should invest in bonds, what is the process for investing through KCB Capital. So Timothy Macharia has taken us, through growth versus savings. That is how to grow your personal wealth. He's also taken you through how to select suitable investment and the various classes that we have on our play, how to invest in shares, rates, and gold ETF. I'll hold the questions for now. Remember, you can still please share your compliments, your feedback using the icon for Q&A. Allow me now to introduce to you Linus Kangara. Linus Kangara is the head of brokerage business at KCB Capital and has over 10 years experience in brokerage and commodities trading. He has previously worked as a senior fixed income trader at Old Mutual. Other roles that Linus has held include head of fixed income at Lions Capital, finance and commodities trading at Savannah Commodities, and operations as assistant at FIDA Investment Bank. Lina holds a Bachelor of Science degree in Actuarial Science from JKUAT and also an MBA in Finance from University of Nairobi. He is a certified public accountant. Linus, over to you as you take us through the conversation about investing in bonds and what are the processes that KCB Capital can help us in investing in the various classes that we have. Linus, over to you.
Thanks again, Anne, and good morning, esteemed customers, for finding time this morning to be with us as we engage you on how best we can be of greater service to you amongst other services that come to you from the KCB group. My colleague Timothy has articulated very well on matters personal wealth, the various asset classes available, as well as how to select some of these asset classes, all with a view of ensuring as an investor, your long-term financial well-being is not only taken care of, but more so in a balanced manner. In his presentation, he mentioned that to eliminate the randomness of life, the risks, especially in income streams, we need to introduce an element of stability and robustness in our financial investments. In this case, then allow me then to place a little bit more emphasis on one of the asset classes that offers you as an investor the ability to anchor your long-term financial stability in a solid asset base and an asset that we have readily available at KCB Capital amongst other asset classes that were mentioned a little bit earlier. So I'll lay more emphasis on treasury bonds, and here I'll just enumerate the various types of treasury bonds available in our market. But before so, I'd like to give a brief definition of what constitutes a bond. And here, essentially, we are saying that bonds are essentially loans that investors give to either a company, private or public company, or even governments. In return, the investor then would receive periodic payments in the form of interest payments that would be paid in most cases semi-annually, that's twice a year from the date of issue. Ordinarily, bonds would be traded in secondary market exchanges, in our case, the Nairobi Stock Exchange, as well as other exchanges regionally and internationally, amongst institutions like central banks, in more developed jurisdictions, sovereign wealth funds, pension funds, insurance companies, hedge funds, and more banks who would be investors in this. Insurance companies, pension funds tend to have liabilities, which essentially include fixed amounts payable at predetermined dates, either as a life insurance payout or other forms of claims. So these particular institutions would then be investors in the bonds market, basically with a view of matching those liabilities with assets for futuristic payments. There are about 3 or so types of bonds available, and this is usually broadly classified depending on the time to maturity. In our local case, we have treasury bills, which have a maturity of up to 1 year. They are usually issued by the central bank with prices being discounted, and in this case, the discount being the return to the investor. They would ordinarily range from a 3-month paper, 6 months, and a 1-year paper, that is 91 days, 182 days, up to 364 days. Besides that, we do have other types of bonds that would be issued by corporate institutions. In this case, big corporates like in our markets, EABL, and in some cases, commercial banks have issued corporate bonds that have the same characteristics of high yielding returns payable to investors semi-annually. Besides that, we have other shorter term debt instruments, in this case commercial papers, that are issued by companies in an unsecured format for a return. But to lay more emphasis on the most common type of bonds that are available in our market, we have the fixed coupon instruments that are issued by the Central Bank of Kenya for various reasons, mainly for budgetary support and in certain instances for infrastructural development. These treasury bonds carry maturity periods of 2 years, 5 years, all the way up to 25 years, with varying returns that are determined by either a price volatility in the interest rate markets, appetite for funding from government, and generally the macroeconomic environment and the tenor of the paper. The longer the tenor, the higher the return. In a nutshell, besides the treasury bonds, we also do have euro bonds that are issued by the government of Kenya, though listed at foreign exchanges at the London Stock Exchange or the Irish Stock Exchange. And these are also government securities that we are able to link our investors who would want exposure to dollar-denominated debt to invest for purposes of either hedging against currency risk or just diversifying the portfolio return. In terms of the characteristics of some of these bonds, I'll lay some little emphasis on infrastructure bonds that are issued by the central bank that have a tax incentive in the sense that they are tax exempt. The interest that you earn from this particular instrument is tax exempt. So that would really work for investors who have businesses and they would want to more or less balance off some of the tax elements or liabilities in their business. Besides that, in terms of the amounts of money that one would require to invest in these particular investments, it's very friendly. Central Bank of Kenya or Government of Kenya has made it able for investors from a small-time investor to a large-scale investor to be able to put in their money. Treasury bills would attract a minimum investment of 100,000 Kenya shillings and incrementally in denominations of 50,000. The government bonds, the fixed coupon instruments would attract a minimum investment of 50,000 and an incremental of 50. And lastly, the infrastructure bonds would attract a minimum investment of just about 100,000 Kenya shillings, just about $1,000 US dollars equivalent, with incremental investments of 50,000. I note that here there is no limit as to how much money one would put. So if an investor wants to get an exposure of 50 million, 100 million, whatever the amount, at KCB Capital, we are able to facilitate this particular investment. Firstly, by offering you market insights as to where you'd get it best at in terms of pricing, and being able to advise you in terms of placement, whether it's a central bank or purchasing the same paper in the secondary market, we will be able to facilitate that. In terms of the tax element on these government bonds, treasury bills would attract a 15% withholding tax, and the government bonds, other than the infrastructure, would attract 15% for bonds that would have a maturity profile of less than 10 years, and 10% for bonds that have a maturity profile of more than 10 years. In a nutshell, that basically covers the DNA of a treasury bond that is available in our local markets. But more so, I think I'd like to lay more emphasis on the why one would consider bonds to be suitable for the investment portfolio. Bonds would ordinarily work very well for someone who has an investment horizon of slightly over 3 years, due to the liquidity in terms of trading and being able to take care of a return in the long term. Bonds are very important. I submit to an investment portfolio today more than ever before. For a very long time, investors have held the rationale that stocks are the best or are the best investment vehicles for long-term savings. And I still hold that those sentiments are still true today, even in the wake of several stock market crashes at an international scale and even locally when we've been ravaged, for example, since last year by the COVID-19 pandemic. But then we need to uplift or not downplay the role that bonds would play in a proper portfolio construction, so that you do not miss out on any opportunities. Then I'd like to just point out briefly what would be the key benefits of investing in treasury bonds. Now, bonds offer a safe haven for your money. Internationally, there's something we call a flight to quality. When markets are not doing very well in other jurisdictions, you'll find that investors will try and rush and either stockpile their cash in US dollars or precious commodities like gold or silver in the international markets. But here in our markets, in terms of the exposures to asset classes, bonds would offer you that safe haven. And these I would basically explain in terms of what essentially is the difference between, say, stocks and bonds. In summation, bonds would represent debt, and stock would represent equity or ownership in an entity. And the difference then brings us to the first main advantage of bonds, that in general, when you invest in debt, it tends to be relatively safer than investing in equity, basically because when you're a debt holder, you have priority over shareholders. For instance, if the company was to go bankrupt, the debt holder in this case is a creditor and would rank way ahead in terms of liquidation and getting back their money, and the equity shareholders would have to wait a little bit longer until debt or debenture or bondholders are paid up. Secondly, bonds are regulated. They come under the ambit of the central bank and the Capital Markets Authority, and therefore providing a fireproof shield in terms of returns. If your coupon is payable on the 1st of June every year, it will be paid without fail, because these are monies that the central bank pays to the investors. We've never had a situation whereby either a payment has delayed or has defaulted. So that necessarily tends to give the confidence that when you invest in a government bond, you've basically invested in a government. It means that particular instrument has a sovereign guarantee. Besides the regulatory aspect of the investment and the safety that surrounds it, bonds then give you something that my colleague Tim had mentioned, the ability to diversify. Bonds carry a lower risk than other available asset classes. And this is because the fixed income assets are generally less sensitive to macroeconomic risks, such as economic downturns or geopolitical environments. Even if today the GDP of the country shrunk, you will not get less in terms of quantum of your investments. The only exposure would be that your money would be exposed to inflationary adjustments. But in terms of a nil return, then that would not occur. Case in point, I'd like to look at what we have currently in the market, the exposure in real estate. Where most investors over the last, say, 15 or so years have put in quite a huge chunk in developing high-rise apartments for purposes of rentals or even for sale. But in terms of income adjustments, especially post March 2020 when the pandemic hit, we've had instances where most of us, or most firms, have been forced to either reduce salaries, lay people off, and in an essence, this has had a catalytic effect to most landlords, where they either have been forced to either reduce rents, or basically they've had instances where people are moving out of houses, and therefore bringing an uncertainty in terms of the risk element of the income portions that one would receive from an exposure in real estate. So bonds then would be able to give you ability to diversify your investment portfolio. Dear listeners, I think I'd like to pause and look at a very good analogy closer home in terms of diversification. If we were to look at our daily intake of food, what we eat on a daily basis, most nutritionists will say that the more food groups or colors on one's plate, the more nutrients your body would be able to consume, and the healthier one would be. And I concur, and I believe most of the listeners would agree. If, however, for some of us who have an affinity for certain foods. For example, you love chocolate, or you love bread too much, you eat a lot of wheat. If you were to eat these two elements every day, our bodies would suffer from lack of key nutrients and with dire health side effects. It is in this light then that I submit that it is true, the same is true for an investment portfolio's diversification. And as an investor then, one needs to put their money in only one type of security. You don't need to just place your money in one type of security. Then you need to diversify so that you limit the risk or risk that is associated with over-reliance or over-investing in one type of asset class. Thirdly, capital preservation, which is key. In this case, capital preservation basically means that we are intending to protect the absolute value of our investments via the assets that have a stated objective of return of principal. Bonds, when you invest in a 2-year bond or a 3-year bond or a 5-year bond, at the end of the investment period, in this case, the central bank will give you back your principal investment intact. If you give them 50 face value, they'll give you 50. And this is on top of the periodic interest payments that one has been holding. And this is typically because bonds carry less risk. These assets are good choices for investors, especially those who are looking at holding the assets for a longer term period, even to maturity. And therefore, the investor would be able to redeem this particular investment at maturity. One renowned person in the financial space, Warren Buffett, said that the first rule of investing is don't lose money. And the second rule of investments is don't forget the first rule. And that those are all the rules that there are in investments. I think that underpins the element of capital preservation, that we need to put our monies in an instrument that would not create an element of loss or total wipeout of our investments, as we have seen in other very fluid investments that we have made or that are out there that would even be offering better returns, but then they have the risk of total wipeout. In conclusion, I'd like to look at the element of a steady income generation, and fixed income investments can help us generate a steady source of income because in this case, the investor would be able to receive a fixed income amount at regular intervals in the form of coupon payments from their bond holdings, that is every 6 months. And that bonds can really contribute to an element of stability to almost any portfolio. I'd like to brush through the investment process at KCB Capital. And we've fairly made it very, very, very easy in terms of the ability of a customer to be able to invest with KCB Capital, where we assess the risk profile of the particular investor. Here we take you through a questionnaire. We assess the exposures that one would be willing to put, and then would make a recommendation in terms of where you'd place the funds. And then the second process would be onboarding, basically taking care of the KYC requirements by the market regulators in terms of customer details, then the account opening process, and then deposit of funds and investment. After all this is done, then it's just transaction monitoring. We are able to provide you with monthly statements and constant engagements on how your portfolio of assets invested in the financial space are doing. With that, I think is to say thank you for listening to us. Back to you, Anne.
Thank you so much, Linus and Timothy, Leah, and also Catherine for that elaborate introduction to this session. So for our dear customers who are on the call, please remember to use the icon for Q&A to ask for any clarification, any questions to our very able panelists for this morning. So I know, Linus, you have touched about the process, but then the question that is coming through, how can KCB Capital proactively help clients choose the best investment option? Noting probably I have like 100 million in my account. How can KCB Capital help proactively do that? And then what is the cost of advising customers to make the right choice? Is there a cost to it? Allow me to take one more question that has come from Helen, and Helen asked, what are the top 10 leading common shares in terms of dividend payments? And another one from Valentine Miheso. Thank you, Helen and Valentine. Could you share the top 10 rates and ETFs to invest in? Over to you. I can start with Linus, then to Macharia.
Thanks, Anne. I'll take, I think, two of those questions. I'll first tackle a question that has been raised around the cost of advising a client. The cost is zero. We do not charge for advising a client to invest. That we offer. We enhance our ability by enlisting our clients into our research material, which we churn out on a regular basis, and these would carry investment recommendations in certain stocks, or basically how the markets are performing. So proactively, that would be able to push information to our customer as to what they can do. And that said, the customer or the investor can reach us at any time, and would be able to have a one-on-one with a particular investor, and basically be able to model a portfolio that would be able to fit the investment needs. In terms of the top performing stocks, my colleague Timothy will cover that.
Thank you so much, Linus, for that in-depth insight on investment in bonds. I think let me start with the question on dividends. The top dividends paying stocks, and I want to answer this question this way: that the top investment. I don't know. There are a lot of shares that pay dividends in the market. And these shares are always in demand. So a case in an example, I'll give an example of maybe a stock like Safaricom. Safaricom last financial year, it gave a dividend of 1.4 shillings, but by then the stock was around 28 shillings. So if you do 1.4 divided by 28, that gives you a dividend yield of about 5%. But then Safaricom in the last 3 months, it has climbed from 28 shillings to 38 to almost 40. Now, the fact that we are basing our yield on the last dividend paid, then the yield might be low. But when you combine the returns, on dividend and also the returns on capital gains, these returns even surpasses 20%. And I can tell you such a return on any investment is very unlikely. We don't see such returns in wide variety of asset classes. Even in real estate, the normal rental yield will give you around 6%. So this is a very huge investment. So on dividend payment, I would say this: you can combine a portfolio of it, so that you expose yourself to high dividend paying stock, but also potential capital gains, so that the portfolio balances in terms of yield. There are stocks that pay huge dividend like BAT. They distribute almost 100% of their profits. The yield, as I had shown there, is about 8.4%. But again, you realize maybe the price might be stagnating a little bit, so that compared to Safaricom is aggressive on capital gains. And the other, like agriculture, we have Cooperative Tea. I think the last dividend they had, the yield is about 13%. There's Williamson Tea, that is on agriculture. There's Terco. Banks yield, maybe just when we remove this period of Corona, averagely they have yielded about 7% and above. in terms of dividend yield. And also combined that with about with capital gains, the yield will be maybe more than 10%. So I think I would answer this question this way. Maybe you can talk to us. We can have a discussion of maybe the best exposure you can have, and then we can pick the best option. So because there are various, there are many, there are more than 20 stocks that would give a dividend. So it's just a matter of making a decision there. Number two, on top rates and ETF. Currently, we have one ETF, that is the gold ETF, that gives exposure to gold. This one has really profited every investor who had invested, especially this Corona period. And I'll give this, before Corona, gold ETF was trading about, one unit was going for 1,250, that's 1,250. When Corona hit, because gold is always seen as a hedge when there's economic downturn, gold climbed all the way to 2,000. So if you look at that yield, that will give you a yield of about even 60%. But then when there is a good economic outlook, you realize that maybe people don't buy gold so much. So it's a hedge. You need to have it in your portfolio just to safeguard it. So currently we just have one ETF. Number two, on rate, we have two rates. One by Fahari iRate, the one that I had talked about. It's called Fahari iRate. That one is listed. The RAS distribution, they give a distribution of about 60 cents, and the share cost about the unit cost about 5 shillings. So it was a yield of about 8%. And also you have potential of capital gains. The other one we have is the Econ rates. Econ have two rates. One is a D rate, the other one is an I rate. But those ones are off the counter rates. They still trade NSE, but they are not listed in the main segment. So those are the options you have. So you can talk to us, and then we can explore ways of you investing in those rates. It's a very good exposure for real estate, and it will always do well when real estate does well. So and I hope that going forward, there are other entities will come and risk there. So we'll keep updating on when that time comes. Thank you so much.
Thank you so much, Timothy and Linus, for clarifying those questions that had been asked by Helen and Valentine. So we have another question from Robert. And Robert, thank you for that. He asked, will KCB help to open a CDS account for the purpose of investing in bonds directly with CBK? Then a question from Mike Muko. And Mike, thank you for your question. With the government being broke, are treasury bills the way to go? Allow me to pick one more question from Linda, and thanks, Linda, for your question. What is your take on Bitcoin and cryptocurrencies? That one I'll give to Leah. Okay, I can start with you, Timothy, and for the interest of time, let's try and summarize our responses. So can KCB help in opening a CDS account for the purpose of investing in bonds directly with CBK? Does KCB support on that? And then the other one was, with the government being broke, treasury bills the way to go? I believe that Linus can pick, and then and also for the question for the bonds. Linus?
Thanks, Anne, for those two questions. KCB Capital would be able to facilitate the investor to invest in government bonds via KCB Capital. An investor has the option of going directly to central bank and opening a CDS account, but we've made it much easier internally to be able to take care of that by investing for the customer via KCB Capital at central bank. So then we would be able to smoothen out the process in terms of a placement of either the primary market options or even purchases at secondary market. So we can do that. In terms of the treasury bill way, I think I'd go back to what I mentioned a little bit earlier. It's all about portfolio diversification. Treasury bills and treasury bonds would then come into an existing asset base that an investor has because they cushion against the returns deteriorating in other asset classes. Government continues to pay coupons on a regular basis. I've checked that we are still within the debt ceiling, or basically what one would consider to be healthy debt versus GDP ratios. So one would be safe to put their money in government securities. Thank you.
Thank you for that. Leah, there was a question. Thank you, Linus, for that clarification. So to Leah, there's a question about what is your take on Bitcoin and cryptocurrencies?
Yeah, thank you, Anne. It would be a disservice for me to answer that question, yet we have the expert on Bitcoin and cryptocurrency on the panel. So I'll hand it over to Timothy to just give us his views on Bitcoin. Timothy,
Timothy?
Okay. Thank you so much, Leah and Anne. The thing with Bitcoin, this is what we call a class of asset we call speculative asset class. Speculative means that the fundamentals are not analyzable and they are not deep enough. So this is just an asset. The technology behind Bitcoin is beautiful. The cryptocurrency, a technology called blockchain is very useful. But again, on their exposure, that one is something speculative. No one is sure. It's just a demand and supply kind of an issue. In terms of usability, some countries have banned it, some countries have allowed it. So when exposing this asset of such an asset class, it's a high risk asset class in terms of risk, but also with the high risk, there's also potential of high gains. There's also potential of you losing everything. So these are the facts that you need to understand. So this is more of speculation. You can maybe analyze trends and how they are going and maybe timing. So maybe you can add it as a class to your existing portfolio, but I wouldn't advise your full exposure to it. If, for example, you have 90% invested in good, beautiful asset classes, and maybe you decide you don't want to lose on it, as I said, there's something called FOMO syndrome, so that the train doesn't just leave you. You can decide to put the 5% on it, and then what is the worst? Your exposure is 5%. Even if it ruins, it just go down 5%.
Thank you so much. I think everyone, just like me, is appreciating your analogy about the formal bit of it. So you just don't jump a train because everyone is investing into it. So there's another set of questions. I'll take from Stella Odipo, and thank you for your question. So her question is, does KCB have any investment options that trade and pay in foreign currency, specifically USD? Then Mokohenganga, thank you for your question. Does KCB Capital facilitate gold trading? I think, Masheria, you may need to reemphasize on that. Then Robert Opini, thank you for your question. Do we access KCB Capital directly, or do we go through our KCB Advantage team? I can start with a question from Stella. Masheria, over to you, please.
Thank you so much. The question on gold trading, the kind of exposure we'll give you in terms of gold trading is what I had alluded earlier, the gold ETF. It gives you exposure to gold, and exposure, technically when you buy the ETF, you're buying into gold, but since this gold is not in Kenya, it's stored in a safe somewhere. So you'll get an exposure, and when the gold goes up, your investment goes up. We don't give you the physical gold. That is the kind of exposure that KCB Capital and our stock market, our securities market will give you. It's exposure to gold. It's called the gold ETF.
My apologies, I was muted. Thank you, Masheria, for that. But Stella asked a question about, and maybe Linus can pick on this, does KCB have any investment options that trade and pay in foreign currency, specifically in USD? And maybe I can add on to a question that came through. How can KCB Capital help its clients investing in the international market stock exchanges that include the LSE, the Chinese Stock Exchange, and global funds like the Franklin Templeton? But maybe we can start with a question from Stella Odipo. Linus?
Thanks, Anne, for those beautiful questions. One, in terms of giving KCB clients exposure to investments in foreign or what we'd call mutual funds. It's an active discussion. We are in the process of enlisting some of these mutual funds as the likes of FT to be able to be available to our customers at large. In terms of access to global exchanges, those are also areas that we are exploring with the international partners, on the ability to be able to, for our customers to buy into the stocks of, let's say, Facebook or Apple for that matter. So these are ongoing discussions that are in developmental stages as to what would be the capabilities or what would be the nature of such a workaround to be able to offer that particular service in future. Currently, we do not have investments that are dollar denominated that would be able to, let's say, give a return that is dollar denominated. But that can be taken care of by investing in Eurobonds, which is something that we can be able to facilitate our investors to invest in Eurobonds, either the ones that have been issued by government of Kenya or other African governments that are constantly trade at both the Irish or the London Stock Exchange.
Fantastic. Thank you so much, Linus, for that clarification. Robert asked, does a customer have, do we access KCB Capital directly, or does one have to go through KCB Advantage team? Linus?
Thanks, Anne. I think we are accessible. We as KCB Group want to maintain an open door, a policy when it comes to attending to our client. The client can talk to the Advantage team ordinarily, because they would be handling other transactional matters for the same client, and that particular colleague of ours at Advantage will be able to either service that client full end, or where they are not able, they'll just loop us in, because we are either just a call away. Only that this pandemic has reduced the in-person meetings. We would also be able to tag along in future with that particular Advantage colleague of ours to attend to the needs of our esteemed client. So both would work. I think it's just a question of which one is convenient, but both would deliver the same result.
Thank you so much, Linus, for that. I'll take two more and then we can close the session. But if someone has any burning question, please use the icon for the Q&A and feel free to engage with our panel. So one last question is, how does tax and inflation affect the rate of return on the various investments? How does tax and inflation affect the rate of return on various investments? Then to Macharia, you had mentioned something about sunk costs. So how does one know when they're investing in a investment that you may call, so to speak, a sunk cost? Thank you. Over to you.
Okay, the first one is tax and inflation. On tax, this is the thing. There is currently on capital gains, the tax was halted. So currently we don't have capital gains tax. But on dividends, there's a withholding tax of 5%. So if dividend is declared of maybe 5 shillings, what you get is 95% of that dividend. On bonds, coupon is, there are categories of bonds that are exempt. We call them infrastructure bonds. So those ones you don't pay anything. If you invest $1 million and maybe a coupon is 120,000 or 100,000, you get your 100,000 if you invest in that category of infrastructure bonds. But on what we call fixed coupon bonds, those ones are subject to tax based on tenor. For a maturity less than 10 years, the withholding tax is 15% on coupon. And for investment above 10 years, you get a tax of 10%. So below 10 is 15%, above 10 years is 10%, sorry. So I think that one is well covered. Again, on inflation you understand is the cost of living. So, and that is why I was saying that you need to ensure that your assets are returning. Otherwise, you'll have what we call negative returns. Even inflation is 5% and your return is 2%, then what you have is negative return of 3%, because you have your money, but it's technically money losing value. So you need to ensure that all your assets are invested and avoid what we call dead capital, having assets that are returning either way below or even not returning anything. The other question is on sunk capital, and on sunk capital, this is what we say: if you have new money, making the investment decision on new money should not be based on previous monies that you've made. You need to analyze that if this investment had done, what is the current return, and is adding this new capital going to prop up the return so that it can get where I want to return, or if then it remains below par or not even returning, is the time that this new money needs to be invested in other asset classes that are returning high, because now continuing to invest that, then you lower your return. So that is how you analyze. You first analyze return. How much am I getting? And the best way to analyze return is not in terms of absolute cash, but in terms of percentage. You're saying that this is an asset that is worth 10 million. How much is returning? If it's returning 1 million per year, that is 10% return. Then if it's returning maybe 100,000, it can even be 1% return. So you need to balance. If it's returning way below, don't prop up money again into it. Don't be so much attached. Have a let go attitude.
Fantastic. Thank you, Macharia. Linus, you want to add something?
Thanks, Anne. I think it's well captured on matters inflation. I think the emphasis is to note that as long as the inflationary rates are way below the return on these particular investments, and we would look at it from the fact that most of our treasury bonds have returns of way above 10%. Then net one is returning a positive investment vis-a-vis possibly an exposure in other asset classes. I think it's well covered.
Okay, thank you so much, Linus. There's just two more, then we can close the session and have closing remarks from your side. So someone is asking, does KCB Capital have an online platform that clients can use to buy and sell shares? And the last question, if I already have a CDS account, can I transfer it to KCB Capital?
Thanks, Anne. Yes, we do have an online share trading portal. It's KCB HISA that one is able to access from either the comfort of their desktop, laptop, iPad, or any mobile gadget, and be able to place an order to buy or sell stocks with us. Secondly, if one has a CDS account with another market intermediary, they would be able to come to us and would be able to activate the same account. For purposes of KYC, we just take them through the onboarding process, and eventually be able to transfer the other financial assets that are held in that CDS account, so that we are able to monitor either incremental investments in the stocks from a single house. So that is possible. We just need to get in touch with a particular investor and guide them through the process of activating the same CDS account, and at the same time transferring their portfolio holdings to the new CDS account.
Thank you so much, Linus. And as our dear customers, once again, thank you so much for being with us, since 8:30, and you're now clocking to 10 o'clock. And thank you so much for all the questions you have shared with us this morning. We appreciate for your time. We don't take that for granted. I have compliments from Mokoi Nganga, and thank you, Mokoi, for this. Mokoi says, excellent session. Thank you. Is it possible to get a recording of this session to review later? Yes, that is very much possible. And just as I invite Linus again to come and make his closing remarks, is just to ask this question that was shared by Macharia earlier, where he said, you need to ask your question. You need to ask yourself, are you a robust investor or are you a fragile investor? And then the other question is to not lose your money, and always remember remember that rule. And rule number 2 is just always remember again rule number 1. Allow me now to invite Linus to close the session. And once again, is to appreciate your time this morning and thanking each one of you and wishing you a fantastic week ahead and keep safe. Linus, over to you.
Thanks again, esteemed customers, for really finding time to listen to us this morning. In closing, I'd like to reiterate our resolve to offer you unrivaled investment services that would be able to meet your desired financial objectives. I'd note that in life, all good things are what we desire, but what really counts is the desire to succeed. And success tends to favor those people who are bold. And the English people say that there's some genius or power in boldness, and that we must all start somewhere. The Chinese would then say that a journey of 1,000 miles would begin with a single step. I beseech our esteemed customers that first step begins with us at KCB Capital, so that we can begin a journey with you to longer-term financial stability today. And you can reach to us either on email, give us a call, reach to us through your dedicated relationship managers. And all we can promise is that we shall endeavor to serve you in line with our purpose of simplifying your world to enable you progress. Thank you and God bless.
Thank you so much. Thank you so much once again, and to wish you all a fantastic and a blessed day ahead. Asante sana. Thank you.